So here you are buying calls, buying puts, making some money here and there trading options, but what you don't realize is that you're taking way more risk than what you actually think you're taking. And there is no hazard why we tend to say that weekly options are like the Las Vegas of options and why it's so risky to trade them. And personally, I really didn't realize that risk until I actually started learning more about the implications of trading weekly options. And that's why it's so crucial to understand why weekly options can actually be so risky. And let me tell you my story so you can actually learn from my mistakes and you avoid doing the same costly mistake than what I've done. You see, when I started trading options, I quickly switched to selling options directly. I didn't really spend a lot of time buying options because I realized that selling options was much better than buying options. And one particularity when you sell options is that you take advantage of something that is called the time decay, meaning that every day that passes, options lose a bit of value. And the closer we are to expiration, the bigger that amount. So when you sell options, it's really amazing because now you make a tiny profit every single day. And the closer you are to expiration, the bigger that amount. So you can imagine that when I started selling options, I directly wanted to go toward the closest expiration. I was thinking, well, why don't we just sell 7-day to expiration options so we get the biggest time decay possible and we can make the quickest and biggest money possible. That was my thinking, and that's what I thought was absolutely logical. So what did I do? I started selling options 7 days to expiration because I was thinking that the bigger the time decay, the bigger the profit that I was going to make. But you can see it coming, it did not necessarily go the way I wanted. And that's why in this video I wanted to talk about why trading weekly options can be a terrible idea and how you can learn from my mistakes so you actually don't do the same as me. Also, if at any point you find this video interesting and maybe you learned something from my mistakes, please consider subscribing to my channel and liking this video. That's really the best support you can give me and I'd really appreciate it. But you see, when you trade options that are that close to expiration, there is a very particular thing that you need to understand about those options. And that particular thing is what we call the gamma risk. And obviously I had no idea what was the gamma risk, how it worked and how it was impacting my trading. And weekly options have something that is very particular. The closer we get to expirations, the bigger the sensitivity of the option price relative to the stock price. And this is something that is big to understand. And when you look at gamma, which is the sensitivity of the stock price on the option price, you see that the closer we are to expiration, the bigger the sensitivity of the stock price on the option price. And the further away we are to expiration, the less the option price is going to be affected by the stock price movements. In other words, if you're wrong when you're close to expiration, you're really going to be wrong very badly. Meaning that if the stock goes against you, you're going to feel it in your P&L a lot more than if you were like, for example, 40-50 days to expiration. So when I was in the trade very close to expiration, I would see my P&L fluctuate so quickly. And it's crazy to see the sensitivity of the stock price on the option price. And I can assure you that you really don't feel the effect of the time decay when you're trading closer dated expirations. And I would see my trades go in the red super quickly. And as the stock was going against me, you would see your P&L fluctuate really like a lot. So when I was trading those weekly expirations, if the trade happened to go against me, then my P&L would go in the red like crazy. And the time decay, I wouldn't even feel the benefit of the time decay on my P&L because my P&L was dragged in all sides by the gamma risk. So you would ask me, what did I do, right? Well, obviously I wanted to close my position because now I realized that the gamma risk was killing my position and I couldn't feel the benefit of the time decay. And when I wanted to close my position, that's where the real dark side of weekly options really showed himself. I couldn't close my position. Why? Because there was no liquidity whatsoever. Well, you see, when you want to take a trade, someone on the other side has to take the opposite side of your trade. If you want to buy something, someone else has to take the selling side. And if you want to sell something, someone has to take the buying side. Otherwise, the trade cannot be made. That's really the basics of trading. But now the question becomes, what happens if you cannot find someone to take the opposite side of the trade? What happens if you cannot find a buyer when you try to sell in options? What happens if you cannot find a seller when you're trying to buy in options? Well, simply put, you cannot close your position. And now I was stuck with an open positions where the P&L was fluctuating from red to green super quickly. And this is one of the particularities of weekly options. They tend to lack liquidity. like a lot. And usually people tend to focus a lot more on monthly and quarterly expirations rather than weekly expirations. And what happens for those weekly expirations? Well, it means that there is really few people willing to buy and sell weekly options. And I was one of those. I was one of the only ones trading those weekly options, meaning that when I tried after that to close my position, when I realized my mistake and when I realized that I was really wrong about the time decay, even though it was working, I was just being dragged into a loss by the gamma risk. No one was willing to take the other side of my trade because there was almost no actors. And this lack of liquidity for weekly options, you can really see it when you compare, for example, the open interest for the weekly expirations and the monthly expirations. And for those who don't know what the open interest is, it refers to the number of contracts that are being held right now, meaning that the bigger the number, the more liquid the option, and the smaller the number, the less liquid the option. And you can see that for a lot of weekly options, they tend to be a lot less liquid than the monthly and quarterly expirations. And obviously, what did I do? I had chosen an option with almost no liquidity at all. So I was stuck in a trade, in a loss, where I couldn't go out of the trade because there was no one else willing to take the other side of my trade. So what did I do in the end? Well, to be able to close a trade when you really miss liquidity, you need to move your mid price a lot toward what we call the natural price. And what does that mean for your P&L? Well, it means that you need to take a very big loss so as to be able to find liquidity. Put it that way. I tried to sell an option so as to buy it back at a lower price, except that no one was willing to buy back my options. So I had to propose to a buyer a very expensive price so a buyer would actually accept the other side of my trade. But what does that mean for me? It means a big loss. And does that mean that you shouldn't trade weekly options, that you should never trade them at all? No, that's not what I mean. You can trade weekly options, and I actually trade weekly options only when I trade earnings. But I will never ever trade again weekly options just for the sake of trading weekly options. I will always go for monthly and quarterly expirations because that's where you have a lot more liquidity. And what about the gamma risk? Well, you need to trade longer dated expirations, so your P&L doesn't depend as much on the stock price movements as for weekly options. And that was a big mistake that I've done. Because I was trading closer dated expirations, my P&L was really heavily relying on the stock price movements. Compared if you're trading longer dated expirations, the P&L will rely mostly on the implied volatility and the time decay rather than the stock price movements. And since then, I can tell you that I haven't traded weekly options as part of a bigger portfolio, and I only trade them when I try to trade earnings. Otherwise, I will always stick to monthly and quarterly expirations because of the liquidity and because of the gamma risk, and I will always go for longer dated expirations. I hope that my story about weekly options maybe helped you a bit more understand why when you're selling options you should go for longer dated expirations, and you should really avoid those weekly options that are very closer dated because you could really suffer from them. And if you want to avoid doing the mistakes that I've done, please don't trade weekly options when you're selling options. I hope you enjoyed this video and my mistakes maybe help you understand why you should avoid to trade weekly options that are super closer dated. And if you've been watching until then, I really thank you very much. Please consider subscribing if you've been liking this video, and I'll see you in the next video. In the meantime, I wish you all the best.